All good.
Okay. All right. Well, Rob, how are we doing? Happy spring.
Happy spring.
Golf is here.
Golf is here.
We just had the Masters.
Well, what an ending that was.
Yeah. Good for Rory. I know my heart rate, I think I lost a year off my life watching him bounce back and forth. Hit, one moment he's hitting the greatest shot ever.
Yep. Very much Rory style.
Rory style. And then the next, he hits a shot that looks like, maybe one of my shots.
Yeah. I think like most golf fans, we're both really happy that he won the Grand Slam. Think about how cool it was to actually see that being pulled off.
Yeah.
I can't imagine, we've seen it, but I can't imagine what he has lived through with his last major was 11 years ago, the PGA in 14, and then everyone doubting him, and then him being just the poster boy for the PGA Tour during the LIV debacle. I don't know him personally, but I'd say he definitely deserves something really, really good.
Yeah. And I think his point afterwards, his question was, well, what are we going to talk about next year at the Masters? Because he's been the one under the microscope. And,
that's right.
And he bounced back. He did a great job. So, yeah, and hopefully, he's able to move on, and I think maybe that ties into a little bit of what we're looking at here. We just had the tax deadline. Now,
we did.
Hopefully families can move on from that area, and
unless you've extended,
right? Unless you've extended,
then hold tight.
Still had to write a check.
Yeah. Right. Yeah. Absolutely, you did,
and keep the IRS happy on that end. But markets have been bouncing around still.
Yes.
Bouncing everywhere. Had a little news last night about NVIDIA and Fed chairman talking a little bit today.
Yep.
So the market's reacting a little bit on those two areas. Do you want to take a moment just to lightly hit on that, maybe a little?
Yeah. So starting with what happened, the broad announcement of tariffs, and I think it's pretty clear that was a pretty big move in policy. And let's be honest, you're upsetting the apple cart on the post-World War II global trade mechanisms, right? Clearly, markets didn't like that. I think what it produced was a lot of uncertainty. So you had some pretty big sell-offs over a few days. And then come Wednesday last week, you had this 90-day reprieve, and we had one of the biggest market rallies, I think, since the Great Depression. I think it was top 10. And now you have markets digesting the fact that, the tariff apparatus that the Trump administration may want to put in place hasn't really gone anywhere, at least yet. Still could be out there, but we have 90 days to figure it out. So this goes back to what do markets dislike the most, and that is uncertainty. These are really interesting times we're in, and everyone is very uncertain what this means, not only for our economy, but then, of course, the derivatives of our economy, that being the stocks of companies, right?
Yeah, absolutely. And I think you hit on a great point there, which is, if we go back to since World War II, the world has really enjoyed that global trade. There's been a lot of prosperity with the trade between countries. And now we're looking at it, the tariffs could reverse some of that, where, really putting a strain on some of those alliances that have been out there, and maybe reducing a little bit of that U.S. economic influence that have been on countries around the world. And maybe, it could cause some countries to turn a little more towards China, who produces a lot of goods.
Yes.
Again, uncertainty, right? And, and I think when it comes to investing, after 30 years, at this, one of the things that I've clearly learned is that certainty is unattainable when it comes to investing.
Yes, it's like saying the future is certain. It's not.
No. There are millions and millions of different outcomes just in the next few days, right? And
yes.
we have no idea, right? So especially during times of crisis, like, I lived back through the, in my early career, back through the tech bubble in the early 2000s, then the 2008 global recession, then we had COVID. When there are crisis moments, that it's really, really difficult, almost impossible maybe, to make confident predictions. Right.
You have to be very comfortable in the uncertainty. You almost have to thrive in it.
That's right. And so that's where, you spend time analyzing the information, taking in what you can, and making the best choice possible based on the information that we have. And one of the things that I think is really difficult for a lot of families out there and to do, and this is where I think working with the right financial advisor that's had that experience, that has seen those different times, that investors, they have to act even without that certainty, right? And that even, inaction itself is a decision.
Yes.
Right? Not doing anything.
Actually, sometimes it's the right decision, but
sometimes it is. Sometimes it is. And, but waiting for that clarity often means missing opportunities. And, it takes me back to, where you and I started working together in 2019. And, so it's been right at 6 years at this point. And not long into us, where we started working together, 2020 came around.
Yep.
And you and I had a big decision, to make in terms of what do we do with our portfolios and how do we handle things as COVID was hitting.
Yep.
And we made some decisions at the time. And, I think some of that was obviously based on a lot of information that we were taking in. We made, a decision that really turned out very well. Some of it probably luck, right? Have to put that in there. But with all that, there is a lot of uncertainty. And when the market started bouncing back, or actually before it started bouncing back, we crossed over a threshold of the market being down 30%, and we started buying back in to the market.
In some strategies, yep.
So we had a lot of uncertainty.
Yep.
But with that, we acted even without that certainty, and that certain decisions needed to be made.
Yes.
And so one of the things that obviously I think, as we're looking at client portfolios and where they're at, one of the first questions, maybe the first question I ask anyone, the market, at one point, if we take the high in February to maybe the low where it was, a week and a half or so ago, a week ago, the market was down the S&P was down almost 20% from its high, right? And if that causes angst or, a lot of, causes someone to really worry about the market, then the question is, I think the question we want to start off with is, has your risk profile, has that risk tolerance changed? Do we need to make an adjustment on the portfolio so that you feel more comfortable, with where the market's at? Do we need to make adjustments to things?
Yeah, and it always goes back to what are your goals, right? And there are usually multiple goals in a financial plan, both being short and long term, and we design our plans around those short and long term goals. So that's always the first step. Has there been a change in a goal? Yes/no. Then I always like to go to, okay, how are you feeling? And then what's driving the anxiety? Are you watching the news about tariffs, and is that causing you to react? Or is literally seeing the market whipsaw causing you anxiety? And it's usually the latter when I say, okay, risk tolerance has changed. We probably need to make a couple adjustments. Obviously, we don't want our clients staying up all night thinking about this.
That's right. That's more of our job. We stay up all night. And we have young kids, so we definitely stay up all night. We
definitely stay up all night. And we have pets too. So
thank you for reminding me. But with all that, I love, this slide when we're looking at market volatility and what, if Ryan, if you could pull this up, slide number 2, talking about, where the market's at and what a typical pullback is. What's funny, when I started and first got licensed in 1995, there was which was kind of pre-internet. There was was
that Errol's internet with like the pure dial-up sound? Oh, that was kind of around that time.
It was. Yeah, and you just hope that someone didn't pick up the phone and kick you off. So, with the AOL, we all remember that, the sound of that. One of the videos that one of the interviews that came out was with Peter Lynch at Fidelity. And one of the things he talked about, so this is 1994, in that interview, he said, look, if we go back to 1900 through 1993, so he's doing this interview in 94, right? And he said, look, in the 93 years of this century, the market has had 50 different times where it's pulled back 10%, which happens just a little bit faster than every 2 years.
Yep.
And that statistic, that was in 94, so almost 30 years ago, has continued to play out. If we look at things right now, about every 22 months, just under every 2 years, the market pulls back between 10 and 20%. pretty predictable in a way there. And then if we look at it, about every 5 years, just under that, the market pulls back about 20 to 25%. Again, fairly predictable. And if we know that going in, it's saying, and I don't know that there's a great analogy, but if I knew that if I took off on a plane and that, hey, between 10 and 15,000 feet, there was going to be a little bit of turbulence. And then once we get to 30,000 feet, there's going to be maybe a little more turbulence, right? And then we're going to smooth out at 40,000. If I knew that on every flight, I'm probably not going to be all that anxious, right?
Right.
Now, the difference between a little bit of turbulence and watching your account values.
Well, so you brought up something important there. I think you and I know that these market events will happen. It's just we don't know necessarily when they're going to happen and why.
That's right.
And actually, we were talking about this as a group last year. I think a lot of people in our industry knew that with the concentration at the top, inevitably it was going to break in some way, shape, or form. We just didn't know it would be this, but here we are and we're living it.
Yeah, the Mag 7 have been hit pretty hard. NVIDIA's taken a good wallop today, right? So the when and the why changes every time. We know ballpark a win every couple of years, right? And the why changes every time. And the why, that's the part that when we're watching the news, and now we have social media tied into this that we didn't have 30 years ago when I first got licensed. I think with all the information we're in now society, when we want that information now, and we look at all these headlines, and there's just headline after headline after headline, whether we get on X or Instagram or anything that's out there or Facebook, it doesn't matter. The headlines are not meant to calm us even during good market periods, right? They're always there to keep us glued and keep us scrolling, keep us watching. And they don't do that by painting a rosy picture. They do that by, fear and doubt and whatever that may be, right? And it's pretty easily done right now. So, with all that, the why changes every time. And usually the why is much different, right? Whether it's Brexit, whether it's tariffs, whether it's the housing recession or COVID or whatever it may be, a tech bubble, whatever it may be. That changes every time. But what we know, as we, have seen over, decades and now century plus and so forth, which is that the U.S. economy is very strong. It's the, yes, you can poke holes in piece of the economy for sure. But it's also the strongest of the economies that's out there.
And I think that's what's underwriting this tariff bet, which we'll potentially get into later or on another podcast. I think what we've tried to address the most, at least with our clients and people we talk to, is why haven't they seen really dramatic moves? And there's two answers to that. One, actually multiple answers. One, we design allocations that incorporates this kind of data. What does a downturn look like? So not to say that we've predicted this or see it coming, but everything that we've seen is pretty ordinary. We're in an ordinary downturn. The second part of that is
and Fed Powell, if I can interrupt for half a second, Fed Powell was on. He's actually speaking right now. He said that same thing. Yeah. He said what we're seeing in the market right now is not abnormal.
Yeah, and it isn't. And I think from his perspective, is our treasury market still functioning? And yeah, there are buyers. There's a liquidity mechanism. And I think the second kind of broad answer to that is, okay, let's say you did make some really big moves. Well, one, you're kind of doing it when there's a lot of trouble going on. And much like how we've seen what's caused this downturn, we've already kind of previewed what's going to take us out. And that was the news last Wednesday. And that was one of the biggest rallies I've ever seen in my career. When you hear pundits say that, well, this market's untradeable, that might have been one of the few days where maybe the market truly was untradeable just because how fast everything was moving up. Some of the bid-ask spreads that were reported didn't really make any sense. So if you were going to, and the thing we get is if you were going to move to all cash, when were you going to move back? And you missed a 10% rally. Now, at the margin, as most economists like to say, at the end of that day, you have to decide for yourself, well, what am I going to do next? And you're just going to make the best decisions that you can going forward. But the point is you missed a major rally. And we don't know at the margin whether that news is going to change at all. So again, that's another reason why they don't see big changes in what we're trying to do. But the third thing to that is our underlying managers, they have been trading. They have been making some moves when they feel that it's appropriate to do so.
Yeah. And to your second point there, if we look at this slide 6 here of this deck that I really like, which is bad timing is better than no timing at all and just sitting in cash. And trying to, if we look at this historically, going from 2000 to 2025, investing money into the market each year. And if you had perfect timing in the market, you've got a nice account value. The worst timing, if you buy on the worst days where the market, is up high, you're buying high, versus just being in cash only, and where you would end up. And if we look at it, if you just stayed invested, you end up significantly. I mean, it's secretariat-like, or Tiger Woods-like. It is. You're so much further ahead versus if you just try to time the market and only be invested in times where you feel like the market's going to go up or so forth. The key is to stay invested and check that emotional piece at the door, right? And make logical decisions. I actually heard I watched a video last week with Warren Buffett, and I loved his story here. It was a quick, simple example, but he said, look, if you bought a house for $500,000 and then the market turned and let's say housing prices went down, and someone came and knocked on your door and said, you know what, hey, housing prices have dropped. I want to offer you $400,000 for this house. I know you just bought it for $500,000 a year ago, but I'm going to offer you $400,000 right now. Are you selling? No, absolutely not. Right? We're going to hang on. So same thing here. I know the perspective on it. It's tough at times because we tie so much more emotion into that money piece than we do a house or a car or other assets. But if we look at it that way, if our house were to go down in value, I'm not selling. Right? It doesn't make sense. Why sell just because it went down? I want to sell when it's up. Right? So, having that perspective, I think, really helps. And when we've talked about it the last couple of episodes, which is it really comes down to uncertainty, and certainty in investing really is unattainable. And that's where do you have the right portfolio laid out the right way? Right, to help sustain through all this. And maybe we do want to make some adjustments as we, to take advantage of some movements in the market and so forth. But going to cash just has never been the right answer. And whenever we also look at it, the biggest up days in the market historically have always come right after the biggest down days. And again, you can't time it. And in fact, last week when the market bounced 10%, I was at a conference and, I looked at my phone that morning, market was up a little bit. And then I went to look at it again and it was up big time, right? I mean, as you said, and you're exactly right. It was one of the biggest upturns I've seen in my career in one day. I had actually refreshed my phone a couple times thinking, is there a glitch? Is there something off here? Because it was up so much. You can't time it. No one's good enough to do that. And so it's really that time in the market, having the right portfolio and understanding that, I think one piece of perspective, something that we've talked with a few clients about that have, when we're doing these annual strategy meetings, is to look at it and say, okay, if we go back 12 months, your portfolio and everything looked great, in terms of your financial plan. Do you have enough money saved and so forth? And unfortunately, the market's taken away a lot of those gains over the last 12 months, right? But if we go back a year ago, the plan looked great. Still looks great. Right. So it's just, I think, having some of that perspective, it'll bounce back. We just don't know when. There's that uncertainty on there. And, the tariffs that are out there, it's meant to hopefully boost manufacturing, reduce some trade deficits. I think a big piece is secure some of those supply chains that we saw problems with during 2020. Right? But we do risk that retaliation. We do risk some inflation, which I want to hit on here in just a moment. I want to talk for a moment here about, I think, just to give some perspective a little bit, what does inflation on a tariff mean? Okay. Now, it depends, when we're looking at these goods and services and things that are goods that, that are manufactured, where they manufactured, is it completely manufactured someplace else? Like let's say we look at a Nike shoe. Okay. So Nike, not to pick on them, but let's say that they, that a shoe
kind of the poster child for importing something. So
it's pretty easy to pick on right now,
Yeah.
right? Versus maybe a New Balance that, does a lot of manufacturing here in the U.S. With some of their lines. But let's say that a shoe, I'm just going to use a simple example, but if a shoe was manufactured over in China by Nike for $10 and then it's imported here to the U.S. and now they sell it for $100, well,
Vietnam, I think. Yeah, go on. Yeah.
Nike has tremendous margins on there, right? And that's why, Michael Jordan and some of these guys get such huge annual, compensation packages from Nike. But when we look at that, so let's say that there were a 20%, just to use a simple math formula here, let's say there were a 20% tariff on that Nike shoe. Well, in this case, it's not going to be 20% on the $100 retail price here that we're paying at the store, right? Where that's going to go from $100 to $120 if Nike decided to pass all that cost on to the consumer.
Yep.
It's based on that imported good, 20% of the $10 on the shoe that was manufactured. So now it goes up from $10 per shoe to $12 per shoe. Now the question is, does Nike adjust that price up to $102 to keep the same profit, or do they eat $2 on it and now they only make $88?
Yeah.
Now that's a very simplified version, but just understanding a little bit on that tariff piece.
Well, I can tell you with absolute certainty that the amount will be passed on to the consumer will be somewhere between 99 and 1%.
Yes.
That's about all I can guarantee.
That's right. That's right. It will be a portion of that for sure. Because companies, especially if they're publicly traded, they're often, in their cases, they have accountability to the shareholders.
Sure.
Right. And they're going to need to keep those profit margins. So a lot of that will get passed on. And if you look at it, you look at auto manufacturers, the typical auto manufacturer imports about 60% of that vehicle to get assembled, whether it's assembled outside the U.S. or in the U.S., about 60% versus a Ford who has, I think it's 3 or 4 assembly plants here in the U.S. where only about 20 to 25% of that vehicle is imported. So the tariff may affect a company like Ford less than it does maybe some other manufacturers. And what is that tariff doing? That tariff is only hitting, that imported piece, not eventually the full cost of that vehicle that the consumer's paying.
Right. It's kind of interesting, right? So when you think about like what the general use case is for a tariff, well, maybe it's to fix our trade deficits, and there's a very logical reason why we have trade deficits, right? It's going to cause a one-time price increase, but then ultimately it's consumer behavior that's going to take over. And I think what is the most uncertain right now is whether tariffs in and of themselves will create a pseudo demand shock that will hurt growth. That's the bet that's underlying tariffs. It's the U.S. consumer is strong. You can't operate without us. Could come to fruition, could not. No idea what's going to happen there. We'll just see, right? Yeah. And I think what's most telling in going back to some of the earnings announcements that we've seen, United last night I thought was interesting. They offered a dual outlook. It was one with tariffs and one without tariffs. And that alone is going to drive markets to be volatile. I think the differential between those two outlooks was 30 or 40%.
Yeah, it's a sizable amount. So, will these immediate costs outweigh the long-term gains? That's the uncertainty piece. We just don't know how it's all going to play out. So we'll continue to see some of this volatility. I think it's, again, having, a portfolio that's diverse, allocated across broad areas.
Right.
To help sustain some of this. And, it's, again, if we liked the market, let's say 15% ago. Right. Then again, it goes back to that house analogy. If I were looking at a house and, now that same house is worth, or being offered for sale at 15% less, now I'm a buyer.
Sure.
Right.
Yeah.
So, removing that emotional piece, understanding that, this is more of maybe making sure that, do we have the right risk tolerance? Do we need to reallocate the portfolio to give you a little greater comfort level? Or are you okay where we're at, right, to sustain this? Understanding that this is normal. The ups and downs are normal. Why it's happening, that is the part that changes.
So with that, do you want to go into what getting through this means, or what it would potentially look like for most of our clients, if not all of them?
Yeah, certainly hit on that. What are some points there that you want to start with?
I always go back to it's how you define diversification. We've been very big on private markets for a while, just because you don't have that market psychology mechanism inherent in them. So we do still believe that private markets offer a really good risk reward scenario, even with public markets, being down. That being said, there might be a time where public markets, quote unquote, become a bit more attractive. So you need to have both. So we're always going to have both. But then at the end of the day, because we're financial planning focused first, it's did we accomplish your goal? And for all of our clients is, can you live the life that you want to live through any market cycle? And I think that's going to be an overwhelming yes. And it sounds really boring. It's our industry that preaches it when everything is good. It's broad-based diversification, rebalance. Let's make smart decisions today based on the information that we have. But it proves itself out in markets like what we're going through right now.
Yeah, I think what you just said was absolute gold, because it's spot on. That it's funny when we have years like we just had in 2023 and 2024, and the Mag 7 is taken off. What does everyone want? They're like, hey, Kyle and Rob, can we just buy NVIDIA? Can we just move everything to NVIDIA?
Yeah, right. We feel like we might not want to do that for X, Y, and Z reasons.
Yeah, or let's buy Bitcoin. Let's move everything. Right, and then
triple levered ETFs.
Yeah, why not? Right on. And let me take a loan against my house and do that. And so with that, but then when stuff hits the fan, that's when the typical portfolio that we design comes into play. Yep. And at the end of the day, you're exactly right. It is, can I live the lifestyle that I want through these ups and downs of the market?
Yep.
And we test these portfolios. We run scenarios on them, and we can, happy to, visit with families, rerun that, and show them, hey, yeah, during the 2008 recession, during the tech bubble, during this that we're having right now, yes, the portfolio is still the same. It still looks great. Your outcome should be just fine, and exactly. That's the key. At the end of the day, that the U.S. consumer, which are our clients, can still go travel. Still go spend time doing the things that they want to do, whether that's with family, the hobbies, their friends, whatever they want to go do. They don't need to worry about this piece every day. Go have fun.
Agreed.
Yeah. And, and I think one of the things that we hear out there a little bit, during times like this is, I start to see a lot more marketing from other, I'd say, insurance agents or brokers in the industry, not necessarily an advisor that runs plans. I think we see a lot more products trying to be sold.
Yep.
That, maybe it's an insurance product. Again, going to cash, or going straight to an insurance product, where we go from potential market upswing, which we want to take advantage of, into an insurance product that has limited upside potential, or whatever that may be. I think you got to be careful out there. It's a question, or something that we talk with clients about at this time when they have questions. We always welcome those questions. We can talk through. Does that product make sense?
Always goes back to the use case, right?
Yeah, and I think it's always one of those things. There's a difference between having a financial plan that's designed to sustain and weather this versus someone trying to sell you a product out there because it sounds good to play off the emotions of this time. And we often want to avoid that.
Yeah. Well-diversified portfolio usually has a number of different strategies and products in them. And if you overweight one in a certain environment, it's probably not going to do very well when markets turn. Again, that's kind of when it comes down to rebalancing, right? Is that you're automatically selling high and buying low. The problem with some of these instruments is you can't get out of them.
Yeah, and buying in at that, at this point, oftentimes is not always the best decision. Again, if we've designed things the right way on the front end.
Yeah, case by case, but typically making those drastic decisions isn't the best.
Yeah. Yep. Agreed on that end. Well, I think one of the conversations hopefully we'll see here, hopefully the market will, it will smooth itself out here at some point, because I'd love to dig into some more topics on maybe tax planning, different areas where, who knows how the rate of return, will play out this year for, let's say, the S&P 500. But maybe the best return this year is to do some tax planning.
I agree with that. We hit our clients and prospects with the ideas of Roth conversions, and it always comes back to, since our client base, our households, families, they pay taxes. It's not the headline return that matters; it's their after-tax returns. So, we were going to talk about this a little bit more in depth, but it's something we've been doing. Well, a lot of tax loss harvesting.
Right.
It makes sense to start generating a tax asset that maybe we can use later. Or if we had taken gains in a certain strategy earlier this year, now we can offset them.
Yep.
So at the end of the day, hopefully that tax exposure that these clients will have will be mitigated.
That's right.
And that just adds to their after-tax return.
That's right. I think that's always an important question to answer for anyone when they're looking at an investment. What is my after-tax return?
Yeah. Right? After last year, everyone was cutting checks because they held a lot of NVIDIA. Well,
that's right. Yeah. Well, now you got
a nice tax asset, so you can go find the next NVIDIA and not have to worry as much about the capital gain.
That's right. Well, great. Hey, another great episode talking through things, and we'll see what's going on in the world and what topic we get to discuss next month.
Absolutely. Looking forward to it.
All right. Have a great one, Rob.
Yeah, you too.